Hello guys, it's the Complete Trader and you're welcome. Alright, so in this video I'm going to be talking about how to capture big moves. Alright, so before I walk you through the process, I want to show you a video that I recorded. It was actually a trade that I took right here on this very instrument. Okay, so I took the trade right at this point. Okay, quickly point that out. I took the trade right at this top. Okay, and this is daily chart. Okay, I want you to consider the movement. This is the daily chart. I took the trade right at this point on top here when the market retraced a little bit into our key level, and I took that trade right here, and look at the movement so far. Alright, so in that very particular video, or that very short recording, I was very clear that I was looking for price to reach for these lows. You see this double bottom here? Okay, so I'll walk you through the thought process, but beyond this double bottom there were other things right here. Price was kind of exposed down here, and these are all things that kind of drop price. So let me not go a little bit too ahead of myself, so let me quickly play that video and I'll be back.
Hello guys, here we have price almost hitting our level. This is the daily chart of the volatility 100 index. So now this is the 4-hour. I'm looking to open the 4. Okay, yeah, this is the 4-hour chart. So look at the sell on top there. All right, this sell has been going on for 3 days now. Okay, and that is the point where I have the level I'm expecting for price to reach to. Okay.
Alright guys, so you're welcome back. Now let's walk you through the process. Everything that I was thinking, everything that I was looking at that made me to take the trade. Okay, so now this is the higher time frame. Okay, when you're looking to capture big moves in the marketplace, and if you're ever looking to make trades that are low risk but high probability trade, what you ought to do all the time is to start your analysis from the higher time frame. But if you're looking to capture big moves, you're not looking to frame a trade around 1 hour, the hourly time frame, the 15-minute, no, you are looking to start off your trade from somewhere around the daily. You understand what I'm saying? The weekly, the monthly. Okay, but in this case we're using the daily. All right, because it takes more time for these candles to form, and they cover a lot of they make a lot of movement. So one thing that you have to really pay attention to now again is that the higher time frame charts, it takes a lot to move these price charts. Okay, it takes a lot to move price. Okay, so you want to ask yourself, who actually causes price to move? Alright, so there are a lot of concepts for trading out there, but what I believe is the big institutions, they are the ones who actually make the price or make price to move. Alright, so when we talk about big institutions, we're talking about people with large pockets, people who have deep pockets, lots of money for trading, lots of equities. But aside from the institution traders, you also want to pay attention to the liquidity providers, because in the absence of the institution traders, the liquidity providers as well can play the same game or the same pattern that institution providers, the institution traders would have used. All right. So basically what these guys do is that they use the liquidity of small funded traders, right, to fill up the trade, and then that's what they do. They just distribute it as well to these guys as well. Okay, so they want to buy low from the hands of these small funded traders, and then sell high to the small funded traders as well. Okay, so let me just quickly walk you through. It may not be that clear to you yet, but I think as I pointed out, it will make sense. So now we see price from this. Let's begin from the left. From the left here, we can come in. I want to pick a arrow. That's it. So here we see price going up, right? So price was kind of making a higher high, higher high, higher low. Okay, higher low, higher high, higher low. Okay, so here the trend ended right there. Okay, let me pull this up again. So right here, the trend ended when this range was set. This broke market structure right here. So this level was being broken. Okay, see the level I'm pointing at. Okay, this level was broken with this price move down. Now that sets a price movement downwards. Do you get the point? So that sets a price movement downwards. So until price comes back up to break that high, we are officially in a downtrend now. Do you get it? We are now in a downtrend. Now pay attention. This is what I said before. Institution traders, the large fund traders, these are the guys who actually move price. Okay, when they bring in their demand or their supplies into the market, it definitely causes price to move because it creates imbalance in the marketplace. All right, but before they can establish a position in the marketplace, they are going to need counter side liquidity. So if they're going to buy, they need sell side liquidity. If they're going to sell, they need buy side liquidity. So pardon me if I'm not able to walk I'm not able to explain this whole thing in bits and pieces, but I'll do my best to give you the most that I can. So I want you to look here. As price was coming up, you look at this double bottom here. This double bottom, this is structure, double bottom. All right, now this is a point where liquidity is going to be resting. Why? Double bottom, this is called what? This is called support. Okay, so when traders buy support, they are going to put their stop loss below there. So when they bought here, they put their stop losses below there. What is going to be that stop loss? That stop loss is sell side liquidity. If you buy, you need to get out of your trade with the sell side. You need to, when you buy, you need to sell your trade to get out of your position. Okay, so resting below there is what? Sell side liquidity. That is money for the institution traders. They want to take that. Okay, so they are going to be looking at that sell side liquidity, sellers right there, and that is an opportunity for them to buy. All right, so wherever the institution traders see the sell side liquidity of the small funder traders, they are looking at that point to buy. Wherever they see a point where the buy side liquidity of the small traders are resting, they are looking at that point to sell to, and I'll show you that right now. Okay, so I've just shown you the sell side liquidity pool resting below there. Okay, and that is the target already for the big institution traders. Now look on top here. When price broke structure here, I want you to look at what happened actually here. Okay, you see they went up above this former high, right, and retraced immediately. You see they went above it and retraced immediately. Okay, that is liquidity being taken as well up there. But let's look for even a more clearer stuff. So when the market broke structure here, what we are now thinking is that they are looking to get down to that level, but they cannot take price to that level if they have not established their position. Okay, so they need to establish a sell trade so that they will be able to benefit from the price movement to the downside. So if they can be able to, if they can establish a sell trade up there or up there, okay, they will now sell that trade, or rather they will now distribute that position back to the sellers down there, or sell side liquidity down there. If they are able to sell up here, how will they get out of their trade? They need to buy back their position. They're going to use the sell side liquidity that is resting below this support level to get out of their trade. So that is a logical point where they are, where they'll be looking to get out of their trade. Do you get the point? So now we see here, you can see this is called market making, guys. One top, two top, three tops, clean tops. So we have triple top right here. So who is trading triple top? This is called resistance in the retail traders book. Am I correct? Now look at this candlestick pattern, really beautiful candlestick pattern that was printed right there. I want you to look at this. Are you seeing that candlestick pattern? This is called what? Bearish engulfing pattern. Alright, so the bearish engulfing pattern printed, and now retail traders have their signal to enter for a short. You know, after seeing price hit that level 3 times, 1 time, 2 time, and then 3 time, and then the 3rd time we see this bearish engulfing pattern right here. And so now they have their confirmation to enter for a short, right? And what happened? When they enter for a short, their stop loss is going to be above there. Yes or yes? Yes. Their stop loss is going to be right above that level. And what is their stop loss? If you sold, your stop loss is going to be a buy side liquidity in the marketplace. Your stop loss is going to be a buy side liquidity, because when you sell, to get out of your trade, you need to buy back your position. And then look at what happened. The market in one move, look at the large candle, guys. Do you see this? Gave no time for the retail traders to think of removing their trade. It just went right up straight. Took out all the liquidity that was sitting right above there and moved back down. Now, when the price moved back down, that revealed that somebody was selling right at about that level. Somebody was selling above there, because there was buy side liquidity right here. The buy side, the stop loss of retail traders. Now somebody is selling into those buy side liquidity, and price moved aggressively to the downside. All right, so these were all the things that I was seeing and I was looking at as price was playing out. Okay, so what happened right here is that now the institution traders have established a position, and that is their position right there. I want you to understand something. These guys, when they sell, they are looking to make profit. Okay, so when they sell, they want price to go lower for them to buy back. And if they buy, they want price to go higher before they can sell for profit. Do you get the point? And that's what every trader wants. Now, because they have large equity, large account, they are going to make sure that they defend their position. So if they're sold right up there, if they're sold up here, they must make sure and ensure that price never comes back to that point until they have, done away with, they've, disposed of all that they acquired up here. Everything they sold here, they must make sure that that trade or that position is already, cleared before they can allow price to come back up there. So they must defend their position. Do you get that? So once they have established a position right here, the next logical thing for them to do is to look for a point where they are going to dispose that position. And they are not going to dispose the position at a price that is higher because they sold up here. They are going to look for a point where they are going to dispose the position at a lower price. Do you get it? It's a simple thing, guys. You just have to think like a normal trader. When you buy low, you want to sell higher. When you sell higher, you want to buy lower. That's a cycle of profitable trading. Buy low, sell high, buy low. Alright, so now we have this happening. Now we have a complete picture. They have sold up here. They have established their position right up there. Where are they now looking to dispose of their trade? There is sell side liquidity sitting below there. If they sold, they have to buy to get out of their trade. So they need counter side liquidity if they are going to buy. Sitting below there is going to be sell side liquidity. So if they're going to buy, they need sell side liquidity. They are coming to this point. Very simple. All right. So now all I'm looking for is where can I get a good entry? All right. So the moment price broke this this particular level, you see right here, that is a break in market structure. Okay, and this is the leg, the price leg, the swing that broke that level. This price leg broke the swing, and that was the point I was looking for my entry. I want you to pay close attention. What is this pattern we see here? There's this small candle to the left, this green candle, and then this red candle to the right, very large red candle, right? Closing very strongly. What's that? Okay, now if you said the 3-bar pattern, then you're correct. The 3-bar pattern, remember the 3-bar pattern that I taught you guys for free right here on this channel. That is a very powerful trading pattern if you can understand it, if you can really walk with the trend of the marketplace. That can give you a very good entry into price, okay, and a very low risk entry for that matter. So when price printed this, I know they were going to come back, and if they come back to this point, it gives me an opportunity for an entry, and that's exactly what happened. Enter here, and my target was below here, this red line. Now let me point out something to you. Your target may be below there, but that may not be the ultimate point where price is going to. Price can break through that and continues to draw down. But this double bottom you see where we have sell-side liquidity resting is going to be a draw on price. What is a draw on price? A draw on price is just what it means. It draws price. Okay, so since they have taken the buy side liquidity that's resting above there, they need a point where they're going to dispose of their trade, and so they are going to be looking for sell side liquidity. So this is going to be drawing price. It's not drawing price, it's drawing the person that is behind the movement of price, and that's the large fund traders. They are looking for a point where they are going to dispose of their trade. You know, like somebody who has eaten too much, he had too much to eat, and so he's going to be looking for where to dispose of the trade. So the restroom is going to be a draw on well, yeah, that was just a joke, okay, but you get the point. So right here they unloaded, and they are looking for a point where they are going to be offloading. So if they unloaded at the low, they will be looking for a point where they are going to be offloading at the highs. Same thing all over, guys. So this could be a draw on price, but may not be the ultimate point where price is going. Now look below here. There were exposures. Price, had exposed legs down here. And what I mean by exposed legs are, this sharp one-sided movement in price that we have here. All these ones. All these are in a way liquidity as well. Okay, these are also liquidity. What kind of liquidity? Buy side liquidity are sitting below here as well. All right, so there are liquidity sitting below here. Okay, and these are draw on price as well for the liquidity provider. How? The liquidity provider is just overturning liquidity over and over and over and over again. Their job is just to overturn liquidity. They are looking to sell to the buyers. They are looking to buy from the sellers. Just match up trade, and that is the game they play all the time. And so when they have a pretty exposed leg in price that is revealing a one-sided movement or one-sided activity in the marketplace, they are looking to go back to that point and balance that up. That's much I can say, guys, about that. All right, so that's one of the things that they do. Okay, so that is a draw on price. Do you get the point? So when you are looking to capture big moves, this is exactly your procedure. Because the person who is responsible for the big move is the big traders, the institution traders, or the liquidity providers. The liquidity providers can be the guy manipulating price. Yes, they do that a lot. But they just cannot push price anyhow. There is a systematic way that they do it. Okay, so they build liquidity, take the liquidity, then they are looking for a point to dispose it of. All right, so for me, when I see that they've taken the liquidity up there and they are moving away, I know that they may not want to get back. 95% of the time they wouldn't get back to that high. So they are looking to dispose of liquidity, and I'm looking below price to see where they are looking to dispose of that sell trade. Okay, if they took liquidity down here Then I'm looking at both price to see where they're going to be disposing of that buy trade. That's just a simple process, guys. Once you have this picture, right? Once you have this picture, all you are looking for is a point for entry, and this is what we took here. This was a 3-bar pattern, like I told you. Hidden in that 3-bar pattern is a deep concept of the marketplace. All right, so price was exposed here as well, and so it was just normal for price to come back up and balance that up. All right, that's the much I can say about that, guys. But if you want to learn more about all this, stuff, more details, you can look up the City Library, and it's all there. But I think I've given a lot already. I've shown you the picture. This is the thought process. This is all I was thinking. So first of all, we want to ensure we have the market structure in our favor. And number two, we want to ensure we have the institution traders in our favor so that we can ride on their sponsorship. And the next thing is that we want to see a very, very, very logical draw on price. Something that is causing price to, it's causing something that is drawing the price. And it's not really just the price. It's about who is behind price. What are they looking to do in the marketplace? You understand? So that's the much we can take for this one, guys. I'll come up with much more videos. I want you guys to keep your comments coming in. You guys are just awesome. You've been such a wonderful inspiration to me. I say a very big thank you to all of you. I want to give special thanks to a guy from South Africa. Is a very great fella, Matthew Matt. I call him Matt. He's a great guy. All right, love you, brother. And to all of you guys who've been sharing our content, thank you and God bless you all. Okay, see you in my next video, guys.